please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's switch back to the big story of the morning. The status quo rating given by rating agency S&P, joining in to assess the likely impact and any key takeaways from the S&P are Sajjid Chinoy, the chief economist at JPMorgan, and Ananth Narayan, now an independent expert. Good morning to both of you, and thank you very much for joining in. Well, Sajjid, anything to worry about what S&P said, or was it on expected lines?
No real worries, Lata. I think the interesting distinction between S&P and Moody's is one has taken a more strategic view on India, the other has taken a more tactical view. I think there are two realities here, and I think the ratings agencies' approaches reflect those different realities. Moody's is more excited by the fact that we've had all these structural reforms undertaken, and they've forecast potential growth to pick up meaningfully in the next 3-4 years. Implicit in their assessment is the fact that that itself will bring debt to GDP down, even if the consolidated fiscal deficit does not come down very much. That underpins the Moody upgrade. S&P takes a more tactical view, worrying about that consolidated fiscal deficit. You know, it goes on to talk about how state deficits are going to remain close to 3%. There is not much expenditure flexibility, especially given more public investment requirements. The tax to GDP on a comparative basis is still relatively low. So I think I was struck by just how many references there were to the fiscal and public debt for S&P. And I think that underpins the fact that
Sajjid, that is exactly what I want to ask you. Do you share that fear?
You know, Lata, to be fair, we have come a long way over the last 3 or 4 years, but it is equally true that over the last year, some of the fiscal risks have increased. I think we've written a lot about state finances, basically undoing the center's fiscal consolidation in the last 4 or 5 years. So the consolidated fiscal deficit really hasn't moved very much, number one. Number two, there are some concerns about what happens to growth in GDP in the near term, and therefore whether the government can stick to its existing path. And number three, the elephant in the room is oil. If oil continues to trade higher, that will have some impact on the fiscal eventually. So at some level, I do share S&P's near-term concern. But that said, we still expect debt to GDP to come down slowly over time, given that growth is expected to pick up.
Okay, no, I was actually more worried about how much borrowing there will be in January and February. Well, Ananth, your thoughts on how the bonds will open, and more importantly, this fiscal question. Are you expecting more borrowing in Jan and Feb when the timetable leaves it light?
Hey, morning, Lata. I think the bonds could open a little weaker, purely from a sentiment perspective. You must remember that, frankly, rating agencies should not impact, our local bonds in a direct way, given that the overseas limits are almost completely full. In fact, given the choice at 7% 10-year bonds, I think a lot of overseas investors would love to buy, except there are no limits available. So you might see a bit of a slip up, given correction and oil prices and all of that. But I think the big level to watch right now is 705. That's when the RBI cancelled an OMO, which was great for the market from two perspectives. One, it was seen as a yield signal. And second, one of the pain points for the bond market was the relentless supply of bonds from the OMO, both of which hopefully are not going to be in the front line right now. So I think 705 maybe, and there the bond should consolidate. The market is also kind of factored in a lot of bad news. I think we are expecting a small slip up in the fisc right now. I don't think the bond market is penciling in any rate cut between now and the next 6 months. And the market is aware that inflation, CPI, will be above 4% for the near foreseeable future. So I think a lot of bad news already factored in. Medium-term concerns still remain, though. If you go beyond just a short-term 705 kind of number, I think the concerns stem from uncertainty. On the fisc side, there are just too many moving parts, right? There's GST collections and how much of it is refunds. I don't think the market will have clarity till maybe the first quarter of next year. Likewise, commodity prices and oil and what that does, therefore, to the overall equations is a big question mark. Growth will remain uncertain as well. I mean, we'll see quarterly headline numbers. But again, this will not be a broad-based, non-corporate survey as yet. So we still don't know how the small, unlisted companies are doing. And that will remain. And plus, let's not forget, we also have a very uncertain global environment. While, if and when the Fed starts to unwind its balance sheet, while it's a very measured, slow process, it could just have an impact on us in emerging markets, and particularly in India, which has seen a lot of benefit of liquidity coming in. So uncertainty remains. I would still think in the medium term, our bond yields could go up. But for the short term, I think 705 should hold.
So I actually just wanted to take that growth question to Sajjid also. Sajjid, that's another facet of the S&P commentary that we got on Friday. That they did say that there is a downside risk to the outlook and the rating in case growth disappoints. We'll get the next quarter GDP numbers now shortly. Are you anticipating a marked recovery from that 5.7 number?
I would say there's certainly a recovery. I would not sure I'd use the word marked. We do see growth in the low sixes in this quarter, 6.3. But I think the broader point is not the next 1 or 2 quarters. The broader point is when growth does mean revert in 3 or 4 quarters, what is the level it mean reverts to? Does it go back to just 7%, or do we go back to the 7.5% that we saw, in the run-up to both demonetization and GST? And I think there are 2 wild cards here. Ananth spoke a lot about the domestic factors. I think some of those drags will eventually fade. The wild card here is we've had 2 of the strongest global growth quarters in the last decade. And yet our exports have been kind of unconvincing, haven't showed the strength we would normally expect. So one question is, if you get reasonably strong 2018 global growth, will India participate in that? Countering that is oil prices, right? So if oil were to head upwards from these levels, that is an adverse terms of trade shock, which will impinge on growth. So the question is, which of these 2 forces will more directly impact India? Will it be stronger global growth and exports, or will it be higher commodity prices, which in turn constitute a drag on India's growth?
Okay, Ananth, rupee today, dollar is at 92 and change, so we don't see any S&P impact on the rupee?
No, in fact, rupee should remain strong. Unlike the bond markets where actual physical flows into domestic bond markets, frankly, is more a question of sentiment than actual flows, given the lack of limits. I think you could argue that the surprise rating upgrade from Moody's and the positive chat even from S&P, while it maintained a stable outlook, should do well for us in terms of FPI and equity, as well as an FDI over the medium term, if nothing else in terms of sentiment for exporters. And if you couple that with the fact that dollar is at its weakest since the beginning of the year, I think the sentiment for a strong rupee continues. There are underpinnings of worry, though. The fact is our current account deficit has turned negative in the last couple of quarters. Hopefully that subsides and export starts to pick up at some stage. But the combination of oil prices moving up and the fact that our exports aren't doing that great isn't good. And we could have permanent dollars across current account deficit, FDI and FPI and equity actually turning negative, which doesn't augur well for financial stability. So in the short run, I think the rupee strength continues. Dollar is just too weak globally, and the sentiment is just too positive for India. But it does board worries for the medium term.
Okay. Finally, you think 705 will be taken, or the market will hold 705 for fear that RBI is uncomfortable beyond that?
I don't think 705 will be tested, to be honest, but I could be wrong. At any rate, even if it is, I think, at that stage, we will expect the market to expect something from the RBI and therefore hold those levels. So,
what can be the something? Can they do OMO purchases?
I'd be very surprised if they did that, to be honest.
Yeah.
Having said that, I think the sentiment would remain one of, at 6.25%, nobody's talking about a hike as yet.
Okay.
So at 75 basis points positive carry, it just starts to look attractive. But I do think at some stage over the next 6 months, we should go higher from here. We could even see 7.25%, but I don't see that happening right now.
Okay, all right. Ananth and Sajjid, pleasure speaking with you, and I'm sure we're going to touch base with you in a matter of 3 days when the GDP numbers hit the screens. Thank you very much.